Okay, so I go into go to, and then I put create a product illustration. So right now I'm going to create one for Florida, and it's going to be the basic illustration right here. And you always choose the Flex Live, which is the first one. And then it comes up something like this. And then you can put client's name. Today, we're just going to put a value client, and he's going to be a male. And let's change him to the age of, say, 30, okay? And he's a non-smoker. Just everything else leave the same. If he's a smoker, you do change here. And then if you're doing different state, you change up here. And then the next thing is you go into the death benefit and funding. And can you just click on that? You don't choose anything on the yellow, just click on that thing. It brings you over here. So to create an illustration, you always choose minimum death benefit, maximum cash value. Okay. And then you always choose level. And then you go down to monthly. And then in the target premium, you're going to select specific amount. And let's just say he's going to start out at $300 a month. Okay, $300 a month. And then, like, again, I was saying earlier that in the IUL for the NLG, you can do a flexible premium, and you can go into a specific amount of years. So for him, we're going to do $300 a month, and we're going to do it for 15 years. So I'm going to do 1 to 15, where it says from. Okay, and down here, first one, we're not going to do anything for him, like we're just going to leave it alone. And then after this one, I can show you guys how we can turn that into a lifetime of income for him, okay? So then once you put all that in, you can go over here and you can click view. Okay, so for him being 30 years non-smoker, his policy starts out with a death benefit of $256,046. So he's paying into the policy until he's the age of 44 right here. And at the age of 44, he should have at least 67,000 in the cash value. And as you can see, if you look further down, let me see, to the about the age of 65, you can see onto the right side where his death benefit is, it starts to increase, even though he's not putting any more money in. The cash value right here start to increase because it's earning interest from the crediting of the NASDAQ, because the money is participating in the stock market, like the NASDAQ and the S&P 500. So that's a good thing about about the IUL. So as you can see, it keep going until the age of, let's just say he goes and live to the age of,
holy cow.
So he goes to live to the age of 95. As you can see now, he's worth 1,000,000.4, okay? And his cash value. And his cash value is about 1,000,004. And then his death benefit also increases, even though he only put in $300 for 15 years.
And that's assuming no withdrawals yet at all.
Right. So if he does withdraw, let's just say if he does take a loan and he takes out like $30,000 right here, that's $60,000 continue to earn compounding interest because he's taken a loan out. So the numbers still maintain the same. Year after year is going to keep earning the compounding interest. If he doesn't put it back, it's fine. It's going to deduct from his death benefit later in life when he does pass away. Okay. So that's the beauty of it. And then I'm going to show you how you can also run the illustration in beautiful colors so you can see, and then you can forward this to your clients. So once you do that and it looks good, everything looks great. Oh, and also want to show you that on the NLG, your commission is always right on here, target premium, if you see it. And then whatever the percentage of that, I think with NLG is 70% to start. So always look at this number, and then it's 70% of that. And then to do the report on this, you just do run report, hit there on the top.
Well, I got to get the dogs inside.
Yeah, again, if you're not speaking, just go ahead and please mute.
Okay, so this is what it looks like once you do the illustration and you want to print a nice report for the clients to see. So this what it's very nice illustration with a beautiful color. So it tells you exactly, you know, the policy starts at 300 a month. If he was to die tomorrow, this is how much his family would get tax-free. Okay. And then here is another illustration. It just kind of gives you a hypothetical number. Like if he was to be the age of 69, that's how much he would have in the cash value. And then it goes up, as you can see. And then also these, or the amount that pays out if he becomes ill. And then the rest, it just basically illustration tells you how the money is accumulated.
Can I ask a question, Elizabeth?
Of course.
So obviously one of the big attractions to an IUL is living benefits, which correct me if I'm wrong, they define those as critical, chronic, and terminal, right?
Mm-hmm.
Terminal would be if the doctor says you're going to die in 12 months.
Right.
You can start pulling benefits.
Or you can get the whole lump sum.
I guess a critical illness would be more of a short-term illness, right?
Right, right. But what's nice is that even the critical, it gives you either a choice of lump. You get you can get it monthly, or you can get a lump sum.
Okay.
Okay.
Hey, Elizabeth, if I could, just to make sure, because I know I've been selling some IULs, but let's say year 2, they want to increase from $300 to $400 a month as far as their premium, right?
Right.
Because I
Right.
know specifically if you do like a whole life, you have to start a new policy and kind of starts over. So is it as easy as just going into calling up National saying, hey, policy number 12345, we'd like to increase it from 300 to 400. Is it that easy, or is there a
Yeah, it's pretty much like you could call in, make or write a check, and you don't have to be the one. You can have, like, for example, I have some parents that did that, and they wanted to know what is the maximum contribution by the end of this year. They just started their policy. So by the end of this year, and the best thing for anyone who has an IUL is you want to max fund it the first 7 years of the policy, because that will then bring the most cash value in the long run. And then after that, you don't have to put in any more, like you can stop putting it in, or you can put in the minimum, what is required. So yeah, you can put in whatever, as long as it meets the IRS requirement for that year. So like, let's just say if you have a $300 policy and you want to put an additional 200, you can call NLG, or you can write a check in that account with the policy number, and then you send it in.
Elizabeth, doesn't NLG have an app also that you can have on your mobile device?
Yeah, you can do that.
You
Yeah,
can do all that from the app too.
any of these carriers, you can actually download the policy, and you can kind of get. Sorry, who's that?
That was Regina.
Oh, okay. Did she
You
say
got something, Regina, or are you just talking?
Oh, I didn't know I was on microphone. I'm sorry.
It's okay, Regina. We love you. Yeah, so yeah, you could definitely do more each month or each year by the end of the year. And then just make sure that, when you do call in to see how much you want to put in, you want to make sure that it's never over. It has to be the exact amount that they tell you that per year.
So I guess the quick answer then to Dwayne's question is it's very simple to change the premium amount, and you can do it on your own if you want, just through the app or check or call them or however you want.
Yeah. Yeah, pretty much. So I guess to recap the whole IUL thing before some of you didn't get into hearing was that the index universal life insurance is, flexible premium. You don't have to put money in for the rest of your life. You can stop, like you can put in for 10, 15, 20 years. It's got, a lot of components like if you want to turn it into a lifetime of income. You can put in more each month than what you started out with. And then, there's a lot like all the benefits the living benefits. So that's why they say that, life insurance is not when you die, it's when you're living. So you can utilize the life insurance when you are alive, the cash value of it, when you become sick, when you become disabled. So that's why it's life insurance, not death insurance.
Hey Elizabeth, so how would they change it to that? Getting paid for the rest of their life. Is there like you have to do something to do that, or?
Yeah, it's pretty easy. You can always call up and, there's like anniversary day where you can change, like you can also change the strategy. For example, if you want to put it all into the NASDAQ or the S&P 500 or the Swiss, you can change it. You have the flexibility of doing that. And then you can also have the flexibility of, changing your beneficiary. If you put more money into it, the next year you don't have to pay a premium, things like that.
Okay, so you just call in and be like, "Hey, I want to put all my money in the Nasdaq," or like that, like you were saying, you just call and say, "Hey, I want to get, I want to get it paid out for the rest of my life."
Yeah, you can
Pretty much.
change it. Like right now, like sometimes we set up and we don't put people in the lifetime income, and later on you can change that.
Okay, that's cool.
Not the agent, but the actual
The policyholder, yeah,
right.
that's cool. Wow.
And let me go and see if I can go back and show you the lifetime income. Okay.
Elizabeth, hey, it's Jerry. I have a quick question.
Okay.
How
Sure.
do you best explain how you can you can you can earn in the games, but up to whatever, but you can never lose so much in the market on your cash value?
Oh, okay. Well, it's pretty much safe at floor. So when your money is earned, it basically goes every time when it's, I guess, called point to point, right? At the end of the year, it's credited you for whatever the earning is. And then if the market doesn't do very well, you don't earn anything. Does that make sense?
Yeah, it does, but you can't lose. You can't lose it either below a certain point, correct?
No, okay, for example, here, your cash value, let's just say it's at on the 40, at the age of 40, and you're at 41,000, right? So that's your earning up to that year or up to that age. The market doesn't do too well this year. So everyone else losing money on the market. Your money stays the same here because it's safe at floor, either floor or 1%. It depends on what strategy you're set up to earn. But you never lose your money. Your money's always safe in life insurance.
Hey, Elizabeth, would you say it'd be safe to use the terms that with an IUL, you could tell your customer, look, just to keep it in simple terms for them, you have a floor and you have a ceiling.
Right.
You're never going to go below the floor.
Yep.
And you're never going to go above the ceiling. Now, the ceiling might not be as good as the market that year, but it'll be at a particular level.
Right. Yeah.
Is that a good way to explain it?
Yeah, with all the loss, like even at the fees and stuff, your money still comes out better in life insurance than even in the market or the mutual fund, because there's so much fees in that versus the cash value in the life insurance.
Do you happen to know with NLG what they use as an index number? Isn't it like 7 or 8%?
I think as high as 9%.
I'm talking about these illustrations.
Oh, you mean hypothetical? I think it's 7%, but I'm
Yeah.
not sure. But yeah,
Okay. It's like a historical index over like the last 25 years.
yeah, the last,
Yeah.
yeah, exactly. They use a certain amount to just give you that
And it's
hypothetical.
compounding too.
A what?
Compounding.
It's
he said.
compounding. It makes interest of interest as well.
Right, right.
Yeah.
Okay, so,
Hey, just a question real quick, Elizabeth, while you still got that. So going to back what you were saying, so if you wanted to increase, you were saying you just can't go over the amount per year, the MEC premium. Is that what you're talking about?
right. Okay, so, I mean, it gets into a little bit,
But it changes the next year, right? Like it changes the year after.
right, because let's just,
Increase.
this year you decided that you don't want to max fund it and you want to just keep it like minimum. And then next year you do really well and you want to max fund it for like the last 2 years, then
Right.
you can double the funding from last year to this year.
Okay. So you
But
just can't,
you
so
always,
you just can't go over that amount for that year. So next year, basically it'll change.
right, because when you go over, then it's considered investment. That's why everything has to be, you know, they don't want you to put all your money in there and then take it out whenever you want to. It's based,
Right.
yeah.
Okay.
Okay, I just want to show, quickly go back to the illustration so I can show you what this person can actually get, a lifetime of income if they decide to change it, okay? So you go back into the death benefit and funding. And then, so let's just increase this to say 500. And he's gonna do it for 20 years. And then he wants to change that into a lifetime income. Okay, did you guys see what I just did? So basically just increase, I mean, just change that to the distribution as a lifetime income. When he retire, he should be able to get. Okay. So around his retirement age, which is around 60, he's gonna get 20,000 each year. And then it increases as well. And then also the cash value is still there if you want to utilize that, okay? And then since he's diving into getting a lifetime of income, his death benefit will decrease. But it always leave an energy, it always leave you a minimum of $15,000. Kind of like a final expense fee.
Yeah, but at the
Okay,
end
so
of the day,
the cash
that's,
value right there.
I'm sorry?
Sorry.
go ahead,
Say-
Shadi.
No, so I just have a question very quick.
Okay,
The cash value right there. Now, let's say you read the retirement date where you make 20 grand a year, right?
Mhm.
But you have what, a couple 100,000 of cash value. Can you take loans against that as well?
yes.
If you
Definitely.
take loan against that, they take it out of the death benefit, or they take it out of the income that comes in?
No, they just take it out of the cash value. They take a loan out of it. A loan is, so when you take a loan out, right, you're not taxed for it. So that money goes out, but it's still earning the compounding interest, you see? No matter what amount you take out. You can take out $300,000, $100,000 here, but that money will always and continue to build compounding interest.
That's crazy. It's like kind of, it's like math magic or something.
Yeah, and the nice thing about with the lifetime of income, so hang on one second. So you get a check each month, you know, so that's what almost like almost $1,000, right?
That's considered a loan.
No,
That's why,
because-
correct?
No, it's your lifetime income. You're gonna get this as a lifetime income. Every month you're gonna get a check, and I think it's gonna be, what is that, about 800 something? Anyway, so that's what you get a check. you get on top of a Social Security check, you get this additional to your retirement, and then you get this if you want to utilize it as withdrawal or loan.
That's 1,600 a month.
Pretty good.
Yeah.
Not bad when you could put in, say, 500 a month for 20 years, 15 years even, you know?
Plus,
Yeah,
then-
and
if you need
Yeah.
more, you said you can take a loan out of the cash value,
right.
which doesn't hurt your compounding interest.
No, it doesn't. And that's what,
Eventually, it will hurt your death benefit, though.
right. But you know that they do, no matter what, no matter how much or how long you live, you definitely always have at least, I think in the NLG account, they leave $15,000. Even if you drain out your whole, like you live to be 120 years old.
wow, that's still awesome though. I mean, if you're getting
Yeah.
like if you're getting a social security check plus you're getting like money
Right.
from that, I mean that's a good amount of money.
Yeah. And if you pass away, you know, the next day or something, your family will have this amount tax-free.
Yeah, it's kind of like you're kind of just covering yourself until you retire, and like in case you die, then I mean your family
Right.
will be left over really wealthy, and then you want to make money while you're still living, so you're
Right.
Elizabeth, I'm going to take a guess that as long as somebody can qualify for IUL, you're going to be selling those as opposed to a whole life or a term ROP or whatever.
Right.
No
Exactly.
brainer. Okay. Yeah.
Yeah. And you could do it with NLG or you can do it with mutual, you know. And even if they don't qualify, you can actually suggest to them that, you know, you can have a policy doing the same thing, getting cash value, building your own banking, whatever, and have it, you know, have it on your spouse, your grandkids, your kids. They can hold policy as long as they have their consent.
And I like that, the fact that you brought up a great point where somebody cannot qualify, that they can put it on to their kids or grandkids and still benefit from that.
Right. Exactly.
That's a huge selling point right there.
Right. Yep.
So in that case, then, if I took one out on my grandkid, I'd be the policy owner.
Yeah.
They would be the beneficiary, right?
Well, you set up whoever you want to as the beneficiary.
But it wouldn't be me. I
Right.
would just be the policy owner.
No, you could also be a beneficiary because
Well, I'm thinking if I couldn't qualify for an IUL.
no, but you could be the beneficiary
Oh, okay.
because you're not the insured. The insured is the person like your grandkids if you want to take the policy out on them, right?
Oh, that's right. I'm sorry. I said the wrong term, right?
It's okay. Yeah.
Okay.
So Elizabeth, just want to make sure I'm clear on that. Scott, let's say Scott has dementia. Take one for the team, Scott. Or Alzheimer. He can't qualify for an IUL, right? So
Right.
he picks I don't know, he's paying $300 a month for his grandkid Susie.
Right.
Year 10, let's say year 10, that 59,000, just for example, on this case, that $59,289. Let's say Scott needs to get 20 grand out of that.
Mm-hmm.
He's able to do that as the owner and the payer of this policy,
Right.
correct? That's not
Correct.
going to affect anything with Susan.
Correct. That's right. Yeah, that's
So
why.
technically on an IUL, as long as basically, if you kind of think about it, pick somebody who can qualify and the owner payer is going to be able to benefit from that, basically.
Exactly. That's why when you find someone who can't qualify for an IUL, you always say, well, you know, we can get a policy for you as long as you have someone you can insure.
Now, that's interesting.
But
And
what's
then
that?
basically, what would you recommend for like in case for Scott? Let's just say that 20,000 that he wants to put aside for funeral expenses, mind you, right?
Mm-hmm.
What would he do for that? Okay, so if he passes away, Susie can become the owner. Pull that money for Scott then, right? For his death benefit?
Yeah, well, when Scott passed away, okay, since he already put in a lot of money for the IUL for the policy,
Yeah.
now if it's enough coverage there, even let's just say that Scott already pay up to the years that he wanted to, and it's done. Scott passed away, right?
Okay.
Okay, so the policy still maintain and it continue to earning compounding interest as long as he designate a person like Susie to take care of whatever. So she can now utilize that money as well, as long as there's a person that's right in the policy with him. He's the owner, he's passed away.
So Susie would have access to the cash value and could pay my death benefits, my death expenses.
Right.
Yeah.
Or if you pass away and you put somebody else as a beneficiary, like Susie's mom, then the policy can be done and the payout could be whatever the amount is.
Okay. That makes sense.
That's great for people like if they can't qualify for like cancer or whichever.
Yeah. Like for someone who have cancer, I always recommend, you want to get a little policy like an AIG, right? Just to have it ready for the final days. And then get a policy that if you could contribute money into it for your kids, grandkids, utilize it for later on in life if you need it, then you want to get an IUL for and set it up under Susie's name, grandkids, mom, dad, whatever, whoever can qualify.
Elizabeth, one more quick question.
Yeah.
Just so I make sure I understand, the beneficiary obviously gets the death benefit. Do they also get the cash value?
Well, okay, so what happened on the cash value, they basically deduct from here. So when you take this out, that money is no longer there. The death benefit. Because what happened is, let's just say that they use the lifetime of income. So that decreases from here. Okay. And so the cash value also is taken out from here. So they're just going to get the death benefit. That's why when you have the cash value, you want to use it when you're alive.
Right.
Gotcha. Great, thanks.
Mm-hmm. So any other questions you guys might have for me? Any other questions?
I'm thinking.
Okay, Elizabeth,
Yes.
just to be clear, can you repeat what happens if the person has dementia and she gets the IOL for example, her daughter? How that will work? Because I didn't get it.
Okay. So let's just say you are a parent, right? And you want to get an IUL because you cannot qualify because you have, say, cancer. And so you take it out on two of your kids. Both kids have a policy. You're the owner of it. You pay for it. The cash value continue to increase. The policy is there. You then utilize it as your own money, your own bank. Whenever that money increases, you can take out as a loan or withdraw from it. So it just basically you utilizing how to earn compounding interest or money from as if it's just sitting there. But also you have protection for the, if something was to happen. So you just basically, you often hear it's your infinite banking or your own banking. So that's how people use life insurance if they can't get qualified. They utilize it on their spouse, kids, family members.
Okay, and in case the owner dies, the sons or the daughters can be then the benefit like the second person in charge of that, or it has to be cash out?
Well, if the owner die or if the insured die?
The owner.
Okay, if the owner dies, this is why, like whenever I write a policy for someone, I always try to tell them that when you take out a policy and you're making payment, you want to make sure that if something happened to you, that everybody knows that you have a policy, and that this is either continue paying, right? Or you don't pay for it anymore. That's a discussion between family members. how you guys want to continue paying it if you were the owner and you pass away.
Okay, thank you.
So-
And then we would just let NLG know, like in case like Scott has he's that policy for Susie, right?
Mhm.
So then when he gets that policy, let's just say she's, I don't know, 13, and so then Scott would let NLG know, by the way, God forbid if I pass, Susie's taking over, or where do we put that? Or where do you make that modification?
If the owner, for example, if the owner is the only one responsible for the financial part of paying the insurance, the
Okay.
owner then could discuss it with whoever. Like if they're holding a policy for a minor, I would say discuss it with somebody that could financially either jump in and pay, or at that point you just say the owner passed away. What, and then this is where NLG or any carriers would then say, okay, this is, if you want to continue, get a new owner, and then, or even start over. That part I couldn't tell you. That's for something that I guess the family had to discuss, right? Because it's financial among the family members, how they want to carry on the policy.
Elizabeth, are you saying if the owner passes away, the owner has a policy, but the beneficiary is someone else, the policy can continue?
That I don't know. I'm just saying that that's
Okay.
something that, yeah, that's something that you have to discuss within the family members, right? If you were to pass away, who then would be in charge of continue paying for the policy?
So
And you're
if someone was willing to continue paying the policy, are you saying that NLG would continue keeping the policy active?
That I don't know.
You don't know, okay.
Yeah, that's something that you have to discuss. I don't think that if the owner had passed away and that was the only thing that you're the one paying, you're the policy holder and you're the policy owner. If you pass away, I don't think that you can continue with somebody else.
Right.
Right.
That's what
You can actually keep the policy. It's just as long as the insured didn't die, you can keep the policy because there's an insured list, so it shouldn't be a problem.
Okay, so you can call the
There'll be
carrier.
no owner.
So you can call
No,
the
you just
carrier and have
keep.
the changes.
No, ma'am. You just keep the same policy the way it is. If the insured adult enough now to be able to afford it, they can still keep the policy as long as they pay onto it.
Shadi, let me ask you this then. Like with Mutual and NLG, any of the carriers, so in the case, like let's just say Sherry, or I can't remember what that, okay, Scott dies, he's the owner. Let's say Sherry's 21 now. And does NLG, so let's say Scott dies, I don't know, that Monday the 1st of December. Does NLG or any of the carriers give us a window to where we can transfer ownership to Sherry or whoever's going to be the new payer?
Well, the insured is same as the owner already. The insured has same access as the owner. If the insured is adult over the age of 18, the insured can still keep the policy.
Okay, okay, so she just changes the ownership to her now.
Yeah.
As the payer.
Oh yes, they can do
But-
that. Correct.
But is there a certain window that a carrier gives us? Like, let's just say if December 1st he dies.
30 days.
Okay, so within 30 days, she just calls up
Yeah.
NLG, says, hey, by the way, I'm going to be the carrier. And that way the policy is still great.
Yeah.
Okay.
That's good.
I asked NLG that same question. If you're the owner and then you're also the beneficiary, so then what they would do, like what Shadi just said, is transfer it over to the person that is insured. So yes, you can do that. Exactly what he said.
dang, that's good.
That's good, because before the insured wasn't qualified, now they can hold the policy, which is great.
Well, so like you said, Elizabeth, then it's really important to communicate with your family that you
Right.
have this policy and that, hey, if something happens to me, it's in your best interest to continue this policy.
Yeah.
Even if it's, you can't afford it, maybe a lesser amount, but keep the cash value intact.
Right.
Because as soon as you cash out on the death benefit, it's done.
Right, exactly. Yep.
Huge, guys. Okay, great.
You could also have them as the beneficiary with you also. So when you die, it automatically rolls over to them.
Yeah,
If it's their policy, if you're writing it on so-and-so, you're also the beneficiary, you're the owner and the beneficiary, but then you could also put them
no, you're
as
talking about
the
the insurer.
beneficiary.
Regina, you're talking about the insurer?
Oh, no, wait, I messed that one up.
Yeah, the insurer cannot be the beneficiary.
Right, yeah. Never mind, I was thinking something different. Sorry about that.
No, it's okay.
Because you could
Now-
have somebody else be the beneficiary of it too.
Now, one thing to remember in this scenario is you got to have insurable interest.
Right, exactly. Can't just take life insurance out of anybody.
Yeah, the guy on the side of the road.
The homeless man.
No, guys, but this has been wonderful. This has been a huge selling point. I mean, absolutely, especially for somebody who can't be insured. That's
Right.
huge.
Yeah, and also, you can also do children, newborns. It's amazing that like kids can do it for college, So selling points for children, babies from newborn to even if they didn't get qualified for life insurance before.
Yeah, I have it in my son Charlie.
Okay, good.
Awesome.
Yeah. Since I had COVID with double pneumonia and stuff, I don't qualify for life insurance anymore, which kind of suck.
Yeah, that's crazy, isn't it?
That's all it takes, one doctor visit.
Yeah, one diagnosis.
Also, if you insure your kids and let's say they wanted to use it for you were as a parent, oh, I want them to go to college, but then they decide that they don't want to go to college. You could use it for whatever you want. You can pull the money out for whatever you want. But if a person was to take out a policy, like how they have the college funds, because a lot of people will say this, well, I have a college fund. They have to use that for college. They have
Yeah,
to
you're
buy
right.
books, everything, tuition. And
Yeah.
so with the IUL, they can use it for whatever they want. And also, it doesn't go against the kid. Like if they're applying for a student loan, it doesn't go against them for income because it is a life insurance policy. They cannot use life insurance policies as an income when they're applying for grants or something like that.
Yeah. Good point, Regina.
Elizabeth, can I ask one more question?
Yeah, of course.
So you're sitting down with me as a new client and, I'm interested in an IUL. What's 2 or 3 red flags that you would notice that said, hey, maybe you can be a policy owner, but not the insured?
Well, I
Age,
guess
right?
you would have to share with me some of your health issues. And once I hear what they are, then I might say, well, with that, I would suggest that maybe we can get someone to be the insurer for you, and then you can be the policy holder.
Yeah, what age would be a red flag?
There's no age. I mean, somebody at 60, 65 can still be healthy with no health issue at all, and they can still qualify if they want to put in a chunk of money, because it's better if you start younger, right? But if you start later on life, it just costs more. Life insurance costs more as you get older.
Right, and this is a time strategy too. An IUL is not an overnight thing. It's
Right,
a time
right.
component, right? At least probably 7 to 10 years,
Yep.
depending on what you put in.
Yeah, I think most of I get a lot of questions like, if I put it in today, can I get it out next year? I say, well, it's kind of like, like that prolonging relationship or a diet that you have to be on for a while and then maintain that. And then once you maintain it, then you can be on good health and good fit.
Right.
Yeah.
Also, you just can't have somebody, oh, I want to insure my child for like $3 million because they have like a limit. If you don't have life insurance, like as a parent or as the insurer, they will only let a minor take up to $100 a month. So now, but if I had a high life insurance policy on my own self or, et cetera, then they will let you go up to the amount of what you are actually insured for. They do that to protect the minor.
Yeah. And also they protect themselves, the carriers. They don't want you to take something out that, right? Because the child can't be paying for, $3 million policy.
Right, but because they want to do that so people don't take policies out on children, and then
And then
high
they
amount stuff, and then the children disappears or something weird like that.
Yeah, this was great. Thanks, Elizabeth.
You're welcome. Thank you,
Hey,
everybody.
Thank you.
I just got one more question real quick. So I'm sorry. So whenever they pass away and they put all this cash value in, you said they don't get that nothing happens to the cash value, it just goes away if they would pass away.
Yeah, because the death benefit, because that's how you utilize it when you're alive.
Yeah.
Because that cash value is there for a reason, because you want to use it for like business or
Right.
just whatever it is that you're trying to build a cash value for.
Doesn't the cash value add to the death benefit though, if you don't use it?
No.
I thought it did.
So that's a good point to your clients. This is actually a living policy and not a death policy.
Right. And then you hear that a lot now, trying to do the TikTok where it's like life insurance is for living, not when you're dead.
Mm-hmm.
Utilize it when you're alive.
Great stuff. Fantastic.
You guys, thank you for joining.
Fantastic stuff.
Yeah.
I know you are
Thanks,
doing a recording of
Elizabeth.
this. If I could get a copy, that'd be amazing, please.
Yeah,
I have this great article on IUL Explain, and it's one of like it explains so well, has a little history on the IUL. And if you guys want it, I can send it to you. Just I guess text me your email. Or
What is your phone number, Elizabeth?
Is 941-952-8711. It explains everything about the IUL, even like how much you can put in, where it came from, in the early 80s. And E.F. Hutton actually, life insurance, they used to sell term, right? And then they try to push you on like mutual fund and the other part for investment, but then E.F. Hutton combined the two together. So there's an IUL, the Index Universal Life, where you can do both. So just good
Wow.
story.
It's good stuff.
Yeah.
is everyone that's on this Zoom call, are all of you in our Slack group?
That's
Yeah.
how I got. Yeah, Scott.
Okay, well,
Uh,
I'll post the link for this Zoom recording back into that Slack group.
Yeah, we can go back and look at it. I'll save it.
And Elizabeth, you could probably post a link to, what were you just talking about there?
It's just an article I read, and I just found it explained IUL so well.
You could probably put that right in the Slack group as well.
Okay.
Cool.
All right, you guys.
Thank you.
Yeah, thank you.
You're welcome. Thank you for being on.
Oh yeah.
Thanks, Elizabeth. Good stuff.
Thank you